Welcome back to the Deep Dive. Today, we are really digging into a major story in banking, Wells Fargo.
Yeah, specifically their third quarter 2025 results.
Right. But it's more than just the numbers, isn't it? The big deal is they're finally operating without that regulatory asset cap.
That's the absolute key pivot point here. For about 6 years, from 2019 to 2025, it was all repair, fixing the business, dealing with restrictions.
Tough period.
Definitely. But now, with 13 regulatory orders closed out and the Fed lifting that cap, well, the whole conversation changes.
The focus shifts.
Completely. It's now about aggressively chasing growth, finding those high return opportunities. They can finally use their balance sheet without those constraints.
Okay, so our goal today is to unpack what those cleanup years actually delivered, how it's showing up in these pretty strong Q3 financials.
And crucially for you, the listener, figure out where they're putting that newly freed up capacity, especially thinking about investment banking and, the consumer side.
All right, let's jump into the current results then. What kind of momentum are we actually seeing in Q3?
The momentum looks pretty solid. Net income came in at $5.6 billion,
Yep.
which translates to diluted earnings per share of $1.66.
And how does that stack up?
Well, importantly, both of those numbers are up, not just from the same quarter last year, 3Q24, but also up from the prior quarter, 2Q25.
Right, so it suggests this isn't just a one-off good quarter. There's maybe some sustained improvement happening.
That's the signal, yeah. Sustained operational improvement.
Okay, total revenue was up 5% year over year. If they're really shifting to this high return phase, we'd expect to see the fee income doing well, right?
Absolutely, and that's exactly what we see. The fee side, what they call non-interest income, that was the real driver. It jumped 9% compared to last year.
9% is pretty strong. Any specific areas?
Definitely. Investment banking fees, specifically, surged 25% year over year.
Oh, okay.
And another foundational point management highlighted, loan growth. The linked quarter growth in their period-end loan balances was the strongest they've seen in over 3 years.
So the core engine is starting to fire again. They're actually putting that capacity to work.
It looks that way. Seems like the core business is finding its rhythm again.
That's the foundation, but maybe the key metric for this turnaround story is returns. Return on tangible common equity, ROTCE. What was that for Q3?
It hit 15.2%.
15.2%. Now, put that number in context. Why is that such a milestone for them?
Well, ROTCE basically measures how well they're making profit from the tangible equity they have. And that 15.2%, it's a big step up from 13.9% just a year ago.
Okay, still good.
But compared to late 2020, when they were really in the thick of all the remediation efforts, their ROTCE was down around 8%.
8%. Okay, so 15.2% is a world away from that.
Exactly. It puts them firmly back in the competitive ballpark with their big bank peers. It really suggests those years of internal work, fixing things, are finally paying off for shareholders.
Makes sense. Now, you can't talk returns without talking costs. Non-interest expense was up 6% year over year. That sounds a bit high on the surface.
It does, but when you break it down, it's not necessarily a bad sign, or at least not all of it.
How so?
A big chunk, nearly $300 million, $296 million to be exact, was severance costs.
Okay. Tied to those efficiency drives.
Right, so that's more of a one-time restructuring cost. The other main piece was higher pay linked to revenue, mostly in wealth and investment management.
Because they had a good quarter.
Exactly. Markets were strong, business was up, so they paid their people more. In that context, higher compensation expense is actually, a sign of success.
Right. Costs driven by success, not just bloat. That distinction, seeing expenses as maybe investment or restructuring, is a good bridge to the whole transformation story.
Yeah.
We talked about the asset cap being the big headline, but what did they actually do between 2019 and 2025 to get that lifted?
It was a massive cleanup effort on a huge scale. Obviously, closing those 13 regulatory orders and getting the cap removed were the giant public wins.
There.
But behind the scenes, they were also fundamentally simplifying the whole bank, really positioning Wells Fargo as a streamlined, U.S.-focused institution.
How focused?
The sources say over 95% of their revenue now comes from U.S. consumers and businesses. They basically shed a lot of the complexity that, frankly, got them into trouble in the first place.
And the efficiency numbers tied to this are just staggering. They expect about $15 billion in gross expense savings between 2021 and the end of this year, 2025.
$15 billion. It's an enormous figure.
Where did that possibly come from?
It's a mix. Reducing their real estate footprint, streamlining technology. But the really dramatic number is headcount.
How dramatic.
Headcount fell 24%. It peaked around 276,000 people back in mid-2020.
And now?
Now it's about 211,000 as of Q3, so that's, what, 65,000 fewer roles?
65,000 people.
Yeah.
That's incredible efficiency, but it must have been hugely disruptive. How did they frame that? Was it just cost cutting?
They were pretty clear on this. They called it real improvement in our efficiency. The idea was it came from automation, process improvements, strategic changes, not just, selling off whole businesses or outsourcing everything.
So making the core leaner.
Right. And the goal was to use those savings to fund all the necessary investments in risk management, compliance, controls, essentially the efficiency drive paid for the regulatory fixes. Self-funded compliance, if you will.
They also trimmed the business portfolio itself, right? Selling things off.
They did. They sold or got out of businesses that were generating about $5 billion in annual revenue.
Like what?
Things like their asset management unit, the student lending portfolio. They exited the correspondent home lending channel. Basically, businesses deemed less strategic or lower return.
So a deliberate sharpening of focus.
Exactly. A pretty rigorous review, it sounds like. If it wasn't core or didn't hit the right risk-adjusted return hurdles, it was out. They're left with a much more concentrated set of businesses now, really aimed at that growth phase.
Okay, so the cleanup's largely done, the cap's off. Let's talk about that growth. Total assets are over $2 trillion now, first time ever. Where are they putting that firepower?
The sources point to a few key areas where they can immediately use that extra balance sheet room. Corporate and investment banking, CIB, seems to be front and center.
How so?
They've ramped up their trading-related assets by 50% just since the end of 2023.
50%. Is that risky?
Management describes it as very client-focused, flow-based business, supporting their existing corporate clients. They're framing it as disciplined expansion, not, wild speculative trading.
And within CIB, the actual investment banking advisory side seems to be gaining traction too.
Definitely. They highlighted gaining over 120 basis points of market share in the U.S. since 2022.
That's quite a jump in a competitive market.
It is. And they pointed to a big, visible win, advising Union Pacific on that massive $85 billion deal for Norfolk Southern.
Right, that was huge. Largest announced deal this year, I think.
So far, yes. It's sort of proof, they argue, that the years they spent investing in banking talent and tech are paying off. They're not shy about their ambition either.
Which is?
They've explicitly stated their goal is to be a top 5 U.S. investment bank.
Top 5. Okay, that's ambitious. But, gaining 120 basis points that quickly, how sustainable is that against the really entrenched Wall Street players? Is it just poaching a few stars, or is the whole platform stronger?
The argument seems to be it's the platform. They're leveraging those deep relationships they already have from the commercial banking side.
Yeah.
Lending to giant corporations, now offering them advisory services too.
So it's an integrated approach.
That's the idea. Stick to clients, stick to more straightforward lending and advisory, build trust that way. Growth from integration, not necessarily from taking on exotic risks.
Okay. Speaking of integration, what about the consumer and small business side? Where are the growth levers there?
A big one is trying to get checking account growth going again, using more marketing, better digital tools for opening accounts.
Standard playbook stuff?
Somewhat, but the really big long-term bet seems to be credit cards.
Ah, yes. The numbers look strong there.
New account growth was up 9% in the first 9 months of 2025 compared to the same period last year. It's a high-return business eventually, but there's a catch.
Right, and this catch is really important for understanding their earnings outlook, isn't it? Why is growing cards actually a drag now?
Yeah, it's counterintuitive maybe, but it's all about the upfront investment. When you issue a new card, you incur costs immediately, marketing, acquisition costs, setting aside loan loss provisions right away.
But the revenue takes time.
Exactly. The cardholder needs to start using the card, build a balance, maybe revolve it. Management was very explicit. Growing the card portfolio is an earnings drag for roughly the first 3 years.
3 years.
Approximately. Only after that point do those groups or vintages of cards mature, reach scale, and really start contributing positively to earnings. So they're consciously taking a near-term earnings hit for what they expect to be much higher returns down the road.
That's a significant trade-off. Makes the wealth management story interesting because that seems to be contributing more immediately. They launched something called Wells Fargo Premier.
Yes, aimed at more affluent clients. And the results there look quite positive. Net investment flows into that Premier offering were up 47% in the first 9 months of the year.
47%. Where's that coming from?
It suggests they're doing a better job capturing investment assets from people who already bank with them, but maybe kept their investments elsewhere previously.
Keeping it in-house.
Right. And another good sign internally, and advisor attrition, advisors leaving has declined every single quarter this year. People seem more willing to stick around now that the bank's future looks clearer, maybe brighter.
Okay, so that improved outlook brings us to their future targets. This really highlights the scale of the turnaround. They've set a new medium-term goal for ROTCE.
They have, targeting 17% to 18% ROTCE.
17 to 18%.
Well,
That's quite a leap from the 15.2% they just hit, and miles from that 8% back in 2020.
it's a very ambitious target. And they even added that the 17-18% range is just the medium-term goal, suggesting it's not our final aspiration.
How do they plan to get there? From 15% to potentially 18%.
Well, the story's a bit split. Their commercial businesses, they say, are already delivering really strong industry-leading returns.
So the heavy lifting is on the consumer side.
Primarily, yes. Getting those returns up relies on continued efficiency gains, maybe simplifying the home lending business further, and critically realizing those higher returns from the credit card investments as those vintages mature past that 3-year mark.
And they're underpinning this with changes to their capital strategy, too, lowering their target CET1 ratio.
That's right. They're now targeting a common equity Tier 1 ratio of 10% to 10.5%. That's down from the current 11%.
How much flexibility does that 0.5% or full percent actually give them?
It's significant because it's tied directly to the regulators feeling more comfortable. Their required stress capital buffer, the SCB, was cut by 120 basis points after the latest CCRR stress test results.
120 basis points. That sounds like a lot.
It is. It's a huge vote of confidence from the Fed, and it basically unlocks a large amount of capital that was previously tied up just sitting there as a buffer. We're talking tens of billions of dollars in flexibility for a bank this size.
And you're putting that flexibility to use immediately.
Seems so. They bought back $6.1 billion of their own stock just in Q3.
$6.1 billion in one quarter.
Yeah. And zooming out, since 2019, their total number of common shares outstanding is down by 24%. That's a huge reduction, boosting EPS and ROTCE.
So they have plenty of capital.
They ended Q3 with over $30 billion in capital above the regulatory minimums. It sends a strong signal. They've satisfied the regulators, and they have significant firepower left for more buybacks and to fund that organic growth we talked about.
Okay, final area to cover. The credit and risk environment. Always a key question when a bank starts talking about growing the balance sheet aggressively. Are they sacrificing discipline for volume?
Well, based on the reported numbers, the answer seems to be no, not yet anyway. Overall credit quality was actually described as strong and improving. Net loan charge-offs actually declined 14% year over year.
Declined.
Oh.
And the consumer.
They painted up the picture of resilience, consumer spending holding up, payment rates getting better. The message was very much, we are not lowering our underwriting standards just to hit growth targets.
What about those specific areas that always worry investors? Commercial real estate, CRE, especially office, and that NDFI acronym.
Right. On CRE, particularly office, they stress they're actively managing down their exposure. The office loan portfolio is down by about a third from its peak a couple of years ago.
And valuations.
Stabilizing, according to them. And they maintain a pretty high allowance for potential losses on their CIB office loans, 10.8% coverage. So they seem well reserved there.
Okay. And NDFI, that's non-depository financial institutions, right?
Yeah.
Can be a bit opaque.
It can be. Management acknowledged investors are focused on it. They clarified that for Wells Fargo, the biggest piece of their NDFI exposure is actually lending to large, well-established private equity firms, their fund finance group.
So lending to the big players, not necessarily the riskier underlying assets.
That was the emphasis, focusing on established players, plain vanilla loan structures, underwriting every single loan carefully, trying to signal discipline and avoidance of the really high-risk corners of that market.
Okay, so let's try and tie this all together then. We've seen the Q3 2025 results pretty strong. $5.6 billion net income at 15.2% ROTCE, showing the turnaround's impact.
And we mapped out how they got there, those tough years of overhaul, closing regulatory orders, achieving roughly $15 billion in cost savings, cutting headcount by almost a quarter.
Which freed them from the asset cap. And now we see them deploying that freedom and the $2 trillion balance sheet into specific areas. CIB growth, trying to crack the top 5 in investment banking.
Driving flows in wealth management and making that really significant multi-year bet on credit cards, aiming for those high long-term returns, all while having plenty of capital.
Right. So the knowledge acquisition on this huge corporate pivot is hopefully complete for you. But as always, we want to leave you with a final thought, something to mull over.
Yeah.
Management is hitting 2 points really hard. One, aggressive growth, especially in cards, to hit that ambitious 17–18% ROTCE target. Two, maintaining strict credit discipline, not chasing credit.
Okay, seems logical, but
But remember, that card growth is an earnings drag for 3 years. So consider this. How does that inherent tension play out? The pressure for volume growth to hit the target versus the need to stay disciplined on credit quality, especially over the next 3 to 5 years as those card vintages mature.
that's the balancing act, isn't it? Growing fast enough to please the market without loosening standards and repeating past mistakes. That's really the core challenge for them going forward.
Exactly. The defining challenge of this next chapter, something definitely worth watching. Thanks for joining us for this deep dive.
See you next time.